awesome. Good afternoon, everybody. As it has been for the last 16 years, it's my pleasure to be with you today to present you the results from this year's State of Manufacturing Survey. Before we get into this, just quick show of hands. How many of you actually took the survey this year? Okay, quite a few of you. For those of you who didn't, those are the people you want to talk to in case you do not like what we present today. Don't kill the messenger on this one. So what we're going to do today is we're going to look at some of the key insights, some of the challenges, and some of the emerging trends directly from the mouths of manufacturers. As noted, some of them in this room today. What I want to do is real quickly walk you through what it is we actually did. And for the last 16 years, we've had the same methodology, which gives us a really data-rich file with lots of trend data to compare this to. We did the survey for the months of late August through mid-September. We interviewed 400 manufacturing executives statewide. It has a margin of error plus or minus 4.9%. We go to great lengths with this study, and one of the reasons why it takes us so long, two reasons. One, it's a long survey instrument. It's about 22 minutes in length. We want to make sure that we are talking specifically to decision makers, the people who make the decisions about their own companies. So we interview owners, CEOs, CFOs, COOs, presidents, vice presidents, and managing officers. And we also want to make sure it's representative of the manufacturing community as a whole. So we set quotas based on region, by type of manufacturer, size, to make sure that we're getting an accurate read of the manufacturing community. This is what we do on a statewide basis. We also do additional interviews in the 6 initiative foundation districts outside of the Twin Cities. We do this so that we get some substantive data in some of the smaller pockets of the state. So in each of those different regions, we conduct 50 additional interviews so that we can look at that data on a more granular level. In total, we did 523 interviews, which if you multiply that by 22 minutes, we've got over 11,500 minutes of data to walk you through here. So with that, let's jump into it. We're going to start big picture for a moment in terms of how they see the economy as a whole. And this is a question we've been asking all the way back to our first survey, as Bob noted, in December of 2008. As you think about 2024 as a whole, do you think this year will be a year of economic expansion, a flat economy, or a recession? This year, 42% of manufacturers believe we're in a flat economy, very similar to what we saw a year ago at 45%. 41% believe we're in a recession. I'll talk a little bit more about that in a second. And then down at the bottom, only 12% of manufacturers believe this is a year of economic expansion. That 12% is the lowest we've seen with the exception of December of 2008 in the midst of economic collapse. Just to give you some context, 3 years ago, that number was at 35%. So 12% is a historic low, 41% recession, there in the middle. I think this is important. There's only been 2 other times in our survey in the 16 years where the percent who believed we were in a recession was above 40%. We saw that 2 years ago in 2022. We saw a huge spike. The only other time was in 2008, where 56% believe we're in a recession. So much more of a pessimistic outlook in terms of how they see the economy today. We've also been asking over the last 7-8 years about the business climate here in Minnesota. And specifically, we asked manufacturers, compared to 5 years ago, would you say that the business climate in the state has gotten better, gotten worse, or stayed the same? And we'll start down at the bottom here on the blue. Only 12% say it's gotten better, very similar to that economic expansion number you saw on the first slide there. 30% believe it's basically been about the same, but a majority, the highest level we've seen yet, 56% believe the business climate in the state today is worse than it was 5 years ago. And we've seen that number steadily climb since the pandemic. It was at 46, 46, 50. Now it's at 56%. One of the stats, and Bob references in his remarks, that has been perhaps the most stable data point over the 16 years that we've been doing this is when we ask manufacturers from a financial perspective, how do you feel right now about the future of your company? And manufacturers tell us they're pretty confident. If you go back to the first year that we did this, in December of 2008, 79% of manufacturers, as the economy was collapsing all around them, said they were confident about the financial future of their firms. 78% in 2010. It got up into the 90s in the 2015, 2018 range. Where we are today, 80% of manufacturers say they are confident, 18% said they are not. Not a substantive change, but there has been a change. A year ago, confidence levels were 6 points higher. Those who were not confident were 6 points lower. So the numbers have narrowed a little bit here. And when you look at it, the only other time where we've been at this low of a confidence level is 2008 and 2010. Not significant change, mind you, but we do start to see a little bit of slippage in this confidence number. And what's really dramatic about this data is it's pretty clear where this lack of confidence, erosion of confidence is occurring. And it's not with the larger manufacturers. And what I mean by larger manufacturers are those who have more than 5 million in revenue or those who have more than 50 employees. The vast majority of manufacturers in our sample, as it is in the state, are the smaller manufacturers, those with 50 or fewer employees. And I want to take you to 2019 here, and I know we've got a lot of data here, but if you look at the 2019 numbers, this is the percent who are confident about the future of their firms. And the numbers were remarkably stable across the type of company. Whether you were in the metro area, whether you were greater Minnesota, less than $1 million in revenue, more than 5 million in revenue, less than 50 employees, more than 50 employees, the confidence numbers were remarkably stable. In 2020, we did that survey in September, so 4 or 5 months into the pandemic. We started to see a little bit of a difference, particularly when you started to see, when we looked at, particularly when you started looking at revenue levels and employee size, but more so on the revenues. The smaller revenue firms were a little less confident, and that gap has just grown. And to where we are today in 2024, 71% of manufacturers who make less than $1 million in revenue annually are confident compared to 92% who make more than 5 million. So a 21-point gap there. An equally large gap among those who have less than 50 employees versus those who have more than 50 employees. So smaller manufacturers in particular are less confident now than they have historically been. We've also been tracking, in addition to sort of big picture takes of the economy, the business climate, confidence level, we specifically ask manufacturing executives, as you think about 2024, do you expect to see an increase, a decrease, or about the same level when it comes to your capital expenditures, when it comes to your revenues, when it comes to your profitability? What you're looking at here on this chart is just the percent who expected to see an increase. Because for the first 10 or so years, those numbers were pretty high. Obviously, you can see in 2020, when the pandemic hit, those numbers took a noticeable dive. Since then, they've bounced around a little bit. And where we are today is that 29% of manufacturers expect to see an increase in their capital expenditures. 24% expect to see an increase this year in their gross revenues. And 21% expect to see an increase in their profitability. Historically, those numbers are considerably lower than what we've seen through the majority of our 16 years. In fact, the fall of 2020 and 2008 are the most comparable data points to where we are today. Now that's the percent increase. When you look at the fuller picture here, one of the things that really stuck with us about this data is it wasn't just a drop off in the increase. We saw a noticeable hike in the percentage of manufacturers who said they expected to see decreases, particularly in gross revenues and profitability. So compared to where we were a year ago, in gross revenue, starting on the left-hand side here, The percent who expected to see a decrease was 25% a year ago. Today, it's 40%. A plurality of manufacturers are telling us that they expect to see a decrease in their gross revenues in 2024. A plurality, 41%, tell us they expect to see a decrease in their profitability this year. And when it comes to capital expenditures, they're fairly evenly split. We've seen a lot of more pessimism when it comes to projections about gross revenues and profitability this year. And this is just going to give you an overall look at the gross revenues in particular. There's been only two other times where we've seen the percent who expect to see decreases come in higher than the percent increases. Again, the fall of 2020 and 2008. So you can see kind of big picture in terms of the economy outlooks, we see a lot of parallels right now to where we were well in the pandemic, where we were in the Great Recession in 2008, 2009. Now, next, that's what manufacturers at large was telling us. We're going to look at what a couple of manufacturers, Bill and Craig in particular, have to say about their impressions of the current economic conditions.
Hi, my name is Bill Pattison. I work at West Central Steel, and I'm the Director of Business Development. West Central Steel is a steel distributor and parts manufacturer in Wilmer, Minnesota. I think the last year has been relatively challenging for manufacturers. Interest rates are high, and so investments have slowed down. Steel goes into big equipment and buildings. All of those things can be dependent on interest rates. And so that's been a little bit of a challenge for our customers. Inflation, while it's slowed, still has prices very high. And so there's plenty of cost pressure that we've got in the marketplace, whether it's supplies, whether it is the valuations on buildings that are driving insurance prices up. Certainly those are issues for us right now that we have to address. From a wage perspective, there's the pressure on wages and maintaining competitiveness in the marketplace and making sure that we've got our team rewarded in a way that keeps them here and attracts new people.
My name is Craig Ryan. I'm president of Winiger Inc. out of Waseca, Minnesota. We're a CNC shop, and we do manufacturing for OEMs. We're not that concerned about the economy. We're flat, I would say, but of course we all would like growth. So I do feel that things are moving in the right direction, and 2025, we'll see what happens. This year has been a little bit slower, as mentioned, just working some little bit of overtime, not much, which we're used to working a lot of overtime, so it seems a little bit slow to us. Fourth quarter projections are looking a little bit of the same, and but we're seeing a few little upticks, so we're hoping 2025 starts off and starts increasing. Pricing has settled down some, but it of course went up pretty drastically the last 2 years, but now we see things settling down. Your more normal increases annually, 2 to 3%. On the demand side for us as a supplier, we're seeing our customers, their inventories are finally running out, and they're starting to pick up a little bit. So we see that as a positive.
As far as trends going from a customer basis, it all depends on which customer segment you're talking about. In certain segments, so like agriculture has had a slower year as crop prices have decreased. Farmers aren't buying equipment. There's examples like that. Construction hasn't been as solid as it has been in the years past, but anybody doing anything defense related seems to be doing fairly well. And so it's a mix. It all depends on the segments that our customers are going after. And because steel is a commodity and it's sold into a wide variety of segments, our customer base is very diverse because of that. And so it all depends on where that steel is going.
Awesome. All right, shifting gears a little bit here, no pun intended. We're going to talk a little bit about concerns for manufacturers. And what we do in this particular exercise here is we give manufacturers, in this case, 6 different topic areas, and we say, how concerned are you about this in terms of the impact it could have on your company? And we ask them to rate their concern level on a 1 to 10 scale, where 1 means they're not at all concerned, 10 means they're extremely concerned. And what you're looking at here are the bars that are 8, 9, and 10. So there's a high level of concern. And we put up the numbers from last year as a point of comparison because a year ago, we saw the two top concerns were attracting qualified workers. 44% of manufacturers a year ago said they were highly concerned about that issue. The cost of healthcare coverage at 43%. Inflation, which had taken a noticeable dip last year, was down at 38%, a couple others at 36%, and developing future leaders down at the bottom. Fast forward to where we are a year ago, because we've seen some noticeable differences. Attracting qualified workers has largely stayed about the same. It's dipped 3 points, but well within the margin of error. Cost of healthcare coverage, though, has seen a noticeable bump up in concern. It's at 51% now, up 8 points from where it was a year ago. But the biggest mover is overall inflation. 38% a year ago. Today, 53% of manufacturers rated an 8, 9, or 10 as a high level of concern about how it could impact their company. Cost of employee salaries up a couple. The rest of these are very consistent. But clearly what we're seeing is a more heightened concern about the cost of healthcare coverage and overall inflation. And when you look at this, we've been tracking these two issues for some time. And particularly with healthcare costs, prior to last year's survey, we had seen a noticeable and rather steady decline in concern about healthcare costs. It had reached a high point in 2011 at 71% around the time of the Affordable Care Act. It had dipped, bounced around a little bit, but 2 years ago, only 41% of manufacturers rated it as a high issue or a high concern. It's up 10 points today to 51%. Attracting qualified workers, we had seen a steady climb, a real peak in 2021, and that number has dropped for the last couple of surveys as well. It's down to 41% today. Where we've seen some of the differences here is in size of manufacturers, specifically those who have 50 or fewer employees versus those who have more than 50 employees. And for the most part, this data has been really consistent. Even if we go all the way back to 2008, in terms of a level of concern, both size manufacturers were pretty similar, but we have seen the numbers start to separate a little bit over the last few years. Coming out of the pandemic, this is a concern that tends to be a little more heightened among smaller manufacturers. A year ago, 44% of smaller manufacturers rated a high level of concern. It's up 11 points this year to 55%. It's also climbed with larger manufacturers, but it's only gone up 2 points. The trend line has been the same for the last couple of years, going up for both, but you now have a 15-point concern gap, with this being a much bigger concern among smaller manufacturers than larger manufacturers. I mentioned at the beginning this Initiative Foundation region piece of this, because it does allow us to dig a little bit deeper into some of these smaller pockets. And what we've highlighted in here, these are the top 3 concerns in each of the 6 Initiative Foundation regions. We've highlighted the ones which, from a pollster perspective, I find to be fascinating, or at least informative. We're going to start in the top left corner here, the Northwest Minnesota Foundation. Overall inflation, 80% of manufacturers in this part of the state said they have a high level of concern about overall inflation. That's 27 points higher than manufacturers statewide. Overall healthcare concerns at 74%. That's 23 points higher than manufacturers statewide. So a much higher level of concern about inflation and higher healthcare costs. Going down there in the green, the West Central Initiative region, retaining workers, 52%. That's 18 points higher there than we see statewide with manufacturers. Southwest Initiative Foundation, cost of salaries, 56%. That's 18 points higher than what we see among manufacturers statewide. I'll bring you over here to, to the southern Minnesota. Also, cost of salaries tends to be a more heightened concern here. That's 11 points higher. Up in the Northland Foundation, retaining workers, 45%. That's 11 points higher than statewide. And then the Initiative Foundation region right in there, all of those are somewhere between 11 to 14 points higher than what we see statewide. So there's some individual pockets and differences we see here, but what is really fascinating, if you look at all 6 of these Initiative Foundation regions, healthcare costs are either a number 1 or number 2 concern. So despite there being significant differences by region and by location, healthcare costs is the one constant. It's either a number one or number two concern in all 6 of these regions. All right. What would you say are the 1 or 2 biggest challenges your company is facing that might negatively impact future growth? A year ago, there was clearly a preference for attracting and retaining a qualified workforce. It was the top or the biggest concern that manufacturers told us might negatively impact their future growth. It's dropped 12 points over the course of a year. It's still a big concern. Still 1 of every 4 manufacturers say it's the biggest challenge. But inflation is at 33%, increasing costs of material products at 30%, just slightly larger. They haven't changed much over the course of the year, but they're a little bit higher now than attracting and retaining a qualified workers. The biggest change that we've seen, outside of the drop for attracting and retaining a qualified workforce, is the increase in unfavorable business climate, which probably wouldn't be a surprise when you go back to the second slide we showed you. But a year ago it was 14%. Today it's 21%. A 7-point increase in concern about an unfavorable business climate. That's the biggest change, positive change that we've seen this year. And when you look at this by type of manufacturer, a couple things I would point out here. And it's consistent in multiple places in this data set. Inflation, at the top line there, it's a fairly shared, it's a pretty much a shared concern among your smaller revenue firms and companies and your larger ones. Those with fewer than 50 employees, those with more, the numbers are pretty consistent. There's some differentiation, but for the most part, they're more similar than not. Increasing costs for products is something that smaller manufacturers, both in terms of revenue and employee size, tell us is a bigger challenge for them than the larger manufacturers. Whereas the larger manufacturers are clearly more focused on workforce-related issues. You can see attracting and retaining a qualified workforce, 45% mention that the biggest challenge for them. 49% of those who have more than 50 employees, that is their biggest challenge. So there's some difference there with larger manufacturers placing more of a premium, more of a concern on workforce issues. Okay. As you think about 2024, do you expect to see an increased investment in any of the following areas? And I just want to point out, before we look at this year's data, compared to where we were a year ago, with the exception of automation, which is the only one that's seen an increase of 2 points, a lot of these areas have seen a little bit of a dip in their expected increased investment from a year ago. But at the top of the list, managing cost due to inflation, 53% of manufacturers said they expect to see an increased investment there. 47% growing revenue and profitability, 45% maximizing productivity, and I mentioned there down at the bottom, automation, which we've starting to see some noticeable increases year after year when it comes to automation. We look at this by revenue type. And for the most part, smaller manufacturers, those with less than $1 million annually in revenue, are largely focused on managing cost due to inflation. That's the one area where a majority, 50%, say they expect to see increased investment. The bigger revenue firms tend to be increasing investments in multiple areas, particularly growing revenue and profitability, maximizing productivity, but even some of these down here at the bottom at 43, 46%, 35% for automation are at historic highs. Okay. As you look at applications in your business that can be automated, what are some of the reasons that you're exploring or considering automation? At the top of the list, 32%, 1 out of every 3 manufacturers tells us it's increasing productivity is the reason why they're exploring or considering automation. Eliminating repetitive tasks at 24%, workforce multiplier at 17, improving workforce safety at 15. Also importantly, down at the bottom here, 45% of manufacturers tell us they're not considering or exploring automation at this time. So 45%, close to half. Okay. Thinking ahead, what would you say are the 2 or 3 most important drivers of your company's future growth? We talked about it from the challenges and the negative impact. We wanted to look at it from the positive side. And at the top of the list, by a pretty significant margin, is new customers and markets. But half of manufacturers tell us that's the single most important driver of their future growth. It's up 9 points from where it was a year ago. If you go down to sort of the bottom, implementing and using automation, last year it was 10%, this year it's at 14, a 4-point increase for there. The biggest drop off that we've seen from last year is number 2, hiring new employees. A year ago was 43%, this year 30%. So another indication here that while workforce issues are important, they're just not as important overall as what we've seen a year ago. So next, I want to introduce Greg and Jeff, and you'll hear from Craig again. They're going to talk a little bit about growth and some of the issues that they see impacting it.
Hello, my name is Greg Elliott. I'm the CEO of Seacole. We are a chemical manufacturer and distributor located in Plymouth, Minnesota. We service the regional market, but also the national and international market with industrial and agricultural chemistry. What that means is we service about 8 to 10 different markets, very diverse markets, from agricultural customers like farmers, all the way to very high-tech manufacturing for printed circuit boards and integrated circuits and disk drives. So we really call on a great variety of different customers. We've seen a pretty strong market the last couple of years in the industrial segment, but we see that slowing just a bit. Probably more throughout the summer this year and into the fall. And we're seeing our customers readjust. They're buying a little bit less, they're keeping less inventory and reducing their headcount a bit. So we're seeing that softening in the industrial space. Because we are a very diversified company, other parts of the business are not so soft, and they're growing and expanding pretty quickly. For example, our agricultural business. When you have cutting-edge technology in agriculture like we do, there's great interest, and we can hardly keep up with all of the interest and leads from customers at this point. We have some pretty aggressive growth plans for 2025, and no matter what the economy does, we're going to adjust and take advantage of opportunities. And because we're so diverse, we're going to concentrate on the areas that are growing and expanding, and maybe fill in the holes for things that are not doing so well.
Hi, I'm Jeff Engbrecht, president and founder here at Clearwater Composites in Duluth, Minnesota. And we're a manufacturer of advanced carbon fiber and composite products for OEMs and businesses across the U.S. Priorities for us in the coming year, we still haven't done our yearly planning for next year, but if I had to guess, a good chunk of it is on growth for people, whether growing internal people or hiring key people here at Clearwater. We're still a fairly young company, and we have some growing pains. So to me, that would probably be our main priority for next year. Capital expenditures for this coming year, we don't have many on in our future. We don't see a lot of growth, but we may have some older equipment that we might need to replace or expand some capabilities. That is a potential, but currently we don't have anything slated for next year. We did invest this year on a new curing oven and some CNC equipment. That's always a potential as our business grows for next year, but currently we haven't slated to do that.
As far as supply chain goes, we have seen a softening in that where turnaround is getting better again, not like 2022 or 23, where lead times have gone out from 6 months to a year on some raw material. But I would say we're now in the new normal, which because of staffing for everyone, I think that we've learned to expand the timeline that we expect to get things back in or in the door the first time. When we go to look for capital equipment, the number one thing we're looking to do is advance our technology, do more with less, spend the money in capital instead of human capital. Most of our employees are pretty excited about that. They take on the challenge well and look for their job to become easier. When it comes to automation, we added a robot arm really just to load and unload a single machine. It was our first attempt at it. It was a little rough going at the front end to try to get it all to work. But once we were able to get it doing what we needed it to do, then it lent us to be able to have that employee run more than one machine, run 2 machines, maybe even 3.
The biggest challenge for us in 2025, as it was in 2024, is finding good talent, but more importantly, retaining them and keeping them energized and pointed in a direction of growth for the company. There's a whole generation of these people that are getting ready to retire, and it's going to be very difficult to replace them because there isn't a generation backing them up and backfilling to step into those positions. So it's really a challenge for us to find that kind of talent and experience. And we're finding that we have to bring people in that don't have that background and train them. So it's a different way of looking at retaining people by training them. We have found that the best tactic to retain employees is to create a culture that they enjoy coming to work every day. And they feel energized and they feel impassioned with the work we're doing and helping our customers succeed.
Great. Okay. Let's talk a little bit about hiring to build off of what Greg was talking there in terms of workforce issues. We've seen in a couple places in this data set today sort of lessening of concerns about attracting and retaining qualified workers as a whole. We also see here kind of a drop off in the percentage of manufacturers who are currently hiring. This year's data, 42% of manufacturers say they currently have positions that are open and hiring. 58% said they do not. That is the lowest level that we've seen since we started asking this question. It's similar to where we were a year ago, but if you go all the way back to 2021, coming out of the pandemic, 62% of manufacturers told us they had positions that were open and they were hiring. Today, it's 20 points lower. And on the right-hand side here, among those who are hiring, we asked them what percentage of positions are currently open, and most of them are in that 1% to 5% range, right? 23%, and that's of all manufacturers, which is essentially more than half of that 42% that are hiring, are only looking for 1% to 5% of the positions open. 6 to 10 and 12%, but we're not talking about a ton of positions here that are open, even among those who are hiring, which is in the minority this year. And you see, like we saw in several of those places earlier on, dramatic differences by size of manufacturer. So the larger manufacturers, more than 50 employees, the percent who say they are hiring is actually up this year from 77 to 82%. But it's 50 points lower among the smaller manufacturers. Only 32% of those who have 50 or fewer employees are hiring. And when you go back to 2021, that number is down 23 points. 4 years ago, over half of the smaller manufacturers were hiring. Today, only about a third are. We've also been asking manufacturers for some time, how difficult is it to find and attract the qualified workers you need? And the data has been pretty consistent. 4 years ago, it was 87%, then 84%, then 84%. This year, 79% of manufacturers say it's difficult to find the workers they need. 20% say it's not that difficult. The overall numbers here are not that dramatically different. But what is different, and I would argue rather dramatically different, is the percent of manufacturers who say it's very difficult to find the workers they need. Because 4 years ago, it was 55% of all manufacturers. Today, it's only 39%. And that number has steadily declined since 2021. So when you combine those two questions together, the percent who say they're hiring, the percent who say it's difficult to find the workers they need, I think you see something pretty dramatic that reinforces what we've seen other places in this data. If you go down to the bottom here, those with 50 or fewer employees, 30% of them say they are hiring and it's challenging to find the workers they need. But nearly 3 out of 4 of the larger manufacturers say they're hiring and it's difficult to find the workers they need. So a noticeable difference here again in how smaller and larger manufacturers see the workforce challenge. So what are they doing to address it? And one of the questions we've been asking for a couple years now is, when you're attracting and hiring new employees, what do you want your company to be known for? And this data has been pretty consistent over the last couple of years. And the change from where we were a year ago is very minimal, if at all. There are 4 areas that most manufacturers say they focus on. A work-life balance, 58% say that. A competitive salary, 56%. A safe and work environment, 55%. And flexible shifts at 50%. Even the ones down here, the below, are not that far off, but the 4 at the top are where a majority of manufacturers say they want their company to be known for that. Now, there are some differences over the course of time, particularly on competitive salary. If you look in 2021, 2022, it was about 61, 62% who said they wanted their company to be known for that. It dropped last year, and it's dropped again this year. Obviously, we're going to be very curious to see if that's a trend that continues or if it changes in next year's data. And we also see a difference in size of manufacturers. Particularly smaller manufacturers tend to be primarily focused on work-life balance, competitive salary, safe work environment. That's where a majority say they want to be known for. Close to majority, 49%, say flexible shifts. But if you look at the larger manufacturers who clearly see this as more of a challenge, more of a concern, they're wanting to really be innovators in all of these areas, not just the work environment, the salary, the work-life balance, but also be an industry leader, great benefits. 53% also say career growth. Next, let's look at some planning type questions. We ask manufacturers, does your company have a formal strategic plan? And if you go to coming out of the pandemic for the first couple of years, most manufacturers, not a large majority, but a majority, told us they did have a formal strategic plan. In 2022, we saw that number dip a little bit, and it's basically stayed the same the last 3 years. So no real movement here. About half manufacturers have a formal strategic plan, about half do not. And we're not really seeing any growth in this data over the last 3 years. Now, as we've seen before, and you'll see in a couple of the slides here, it's a kind of a noticeable trend and probably not surprising. Smaller manufacturers are much less likely to have a formal strategic plan. Only a third of those who have less than $1 million annually in revenue have a strategic plan. It's more than twice as high among the higher revenue companies at 69%. Same difference there by employee size. We also asked, does your company, senior leadership, have a succession plan? And these numbers haven't moved much in the last year. 43% say they have. It has dipped a little bit the last couple of years. In 2022, it was at 50%. These numbers look a lot like where they were in 2021, but 43% say they do have a plan. 52% said they do not have a succession plan. And here again, larger manufacturers, both in terms of employee size and revenue, are much more likely to say they have a succession plan than the smaller companies. And then finally, on the planning side here, does your organization have a formal published mission, vision, and values? 47% of manufacturers said they do, 52% said they do not. As we've seen with the other 2 questions, there's a noticeable difference in the revenue levels and the employee size levels. Larger manufacturers are considerably more likely to have a formal published mission, vision, values than the smaller ones. Shifting gears a little bit here, thinking about your business, are you an OEM or a supplier to OEMs? This is a new question that we asked this year. 15% of our samples said they are an OEM. Another 38% said they are a supplier. So about half are either an OEM or a supplier to OEMs, 43% are neither of those. And we didn't see much difference, certainly in the OEM data by type of manufacturer. The supplier levels tend to be higher with larger manufacturers. No real difference by location of whether the manufacturer was in the Twin Cities, metro area, or in greater Minnesota. The data was really consistent across the region. Now, if you may recall, a year ago, we talked a little bit about some of the legislative actions taken in 2023, and we started to pick up in our data some concern that it might be impacting manufacturers. This year, we wanted to dig a little bit deeper on that. So we specifically focused on these 6 aspects of legislation passed last year. And what we asked manufacturers were, are any of these having an effect on your business? And so what we found in this year's data, I think, is pretty dramatic. The 3 that are highlighted in red here, the cost associated with funding new paid family and medical leave program through a new payroll tax split between employer and employees. 32% of manufacturers say this was having a major effect on their business. Another 36% said a minor effect. Only 29% said it was not having an effect at all. If you add the major minor together, 68% of manufacturers say this was impacting their business in some form or fashion. A very similar percentage say the new requirements on an employer for paid sick and safe time. 29% major, 38% minor, but 67% total effect. And then the last one there, the requirement that small businesses must contribute to employees' paid leave at the same rate as larger corporations. 34% said that was having a major effect. That's 1 out of every 3 manufacturers. Another 31% minor, 65% having a major effect. So last year we saw heightened concerns. This year we see real world implications. What is interesting, among these 6, to give you a point of comparison here, or context, 82% of manufacturers in our survey said that at least one of these was having an impact on their business. 82%. 62% said at least 3 of these were having an effect. And even if you just focus on the major effect, 49% of manufacturers said at least one of these 6 was having a major effect on their business. So roughly half of all manufacturers say at least one of these areas was having a major effect on their business. And I will tell you, it's not confined to larger manufacturers or smaller manufacturers or those making less than $1 million revenue or those making more than $5 million annually in revenue. It's impacting manufacturers of all shapes and sizes, all types, all locations. And depending on the topic, particularly costs associated with funding family medical leave, seems to be a little more pronounced with larger manufacturers. But even those with 50 or fewer employees, 68% said it was affecting their business. Cannabis notably wasn't one we highlighted earlier, but for larger manufacturers, 54% said that is impacting or affecting their business. Close to that at 48% among the larger employee size firms. So all of these are not confined to one specific type of manufacturer. It's impacting the entire community. And we not only see it in that particular data, we also ask manufacturers, just based on these legislative developments, has this made Minnesota more attractive or less attractive for businesses, or has it had no real effect at all? And if you look at that chart on the right, only 8% say it's having a positive effect. It's making it more attractive. 24% say it's not having an impact at all. And mind you, that's only 32% of manufacturers who say it's either positive or no effect. The vast majority, 65%, say it's making the state less attractive to business. 45%, close to half, say it's making Minnesota much less attractive for businesses. And it's a sentiment that's shared by all types of manufacturers, right? Metro companies, greater Minnesota companies, smaller revenue, larger revenue, smaller employee size, larger employee size. Those numbers are remarkably consistent across all types of manufacturers. So next, I want to welcome back Bill and Greg and also introduce you to Paul, who's going to talk a little bit about their perspective on these legislative developments and what it means for their companies.
My overall sense is that we don't seem to get a lot of support from the state of Minnesota. Taxes continue to increase. Minnesota now is the highest corporate tax state in the United States. It's difficult to do business in that environment. We see that they went from an $18 billion surplus, spending most of that went away, and then they raised another $10 billion in taxes. It's very difficult to have customers stay in that environment, and that's why I think a number of our customers have left Minnesota, is because of the high tax burden that is present here. Some of the articles I read say that Minnesota is the sixth best state to do business in, but they're not looking at the financial side of it, they're looking at the social side of it. We really feel that because of the way the state government is being run right now, raising taxes is going to really put a stranglehold on business.
I would say that at this point in time, there's not been a lot of positive impact from the legislature on helping businesses grow. Between legalizing cannabis, disruption in employee vacation policies and PTO, as well as the upcoming Paid Leave Act, it just adds a lot of administrative burden to businesses that, for the most part, a lot of businesses are already meeting today, but now has new laws and new regulations around it and new reporting aspects. And the biggest aspect, I think, for manufacturers is this legalizing cannabis. Us, as well as many manufacturers around the state, have safety-sensitive environments. Because of that, we need employees to be at top-notch all the time, aware of their environments, and they can't be under the influence. So without a test that allows us to understand whether employees are under the influence or have just consumed cannabis, it makes it very difficult for employers to manage around these new laws legalizing cannabis.
My name is Paul Harry. We're at St. Cloud Window in Sauk Rapids, Minnesota. My role is the CEO. When the legislature passes laws like family medical leave or earned sick and safe time, those do impact our margins. Those do impact the cost of doing business. The intention is good to help employees and team members, and we're all for that. We'd like more of a voice in how that happens. I think it will impact the company as far as more administrative costs and just costs overall. So it's going to increase our administrative costs and reduce our margins. So it's something that we are going to have to live with and figure out how to work with. I would love to invite any legislators, any elected officials to come and tour our facility, to be our guests, to see how our hardworking people work in this facility and what their challenges are and what our challenges are as owners of the company to grow the company. I would love that.
Awesome. I've got a few more questions here before we wrap up. On the left-hand side here, thinking about formal quality and business management systems such as ISO, is your company pursuing a formal quality system? We've seen a noticeable jump up in the number of manufacturers who say they are. It's up 14 points this year from where it was a year ago. 32%, about a third of manufacturers say they are pursuing a formal quality system. 64% say they are not. And those who are not ISO certified, 7% of them on the right-hand side said their company does have a plan in the future to pursue it. So those numbers, I think we would expect to go up in the years to follow. Some of the reasons manufacturers have given us for why they've implemented a formal quality management system, do any of these apply to you as a manufacturer? And there were three that kind of topped our list. The one where a majority said it did apply to them was improving processes and performance, 50%. Improving quality, 48%, and customer requiring it at 40% were the three top reasons why manufacturers say they've implemented a formal quality and business management system. And you can see, compared to where we were a year ago, all of these areas and reasons have seen a noticeable increase, as we saw with the number of companies who are pursuing this. Next, on the supplier side, we had a couple questions this year that are new. When you look for suppliers, what are the criteria that you're looking for? And we gave them these 5 and asked them to rate on a 1 to 10 scale. How important is it that your suppliers or potential suppliers have these qualities? And you're looking at the 8, 9, and 10s, meaning those who rated it very importantly, or at least high on that importance scale. Financial strength, formal quality program were the top 2, then continuous improvement plan at 26%, workforce development and automation at 15% down at the bottom. And specifically among suppliers, we asked, which of these criteria do you currently have in place? And a majority told us they have a continuous improvement plan, 54%. Close to a majority say they have a formal quality program at 49%. Similar percentage say financial strength plan and then workforce development. And about a third of them said they have plans for automation. So I know we've thrown a lot of data at you this year. I'm just going to spend a couple of slides summarizing this all. And we're going to start kind of big picture again at the economy, because I think one of the key takeaways and changes in this year's data is this heightened concern about a recession. We've seen recessionary fears surge in the last 12 months. This is only the third time in the 16-year history of the study where the percentage of manufacturers who believe we're in a recession is above 40%. While confidence remains high overall, it has dipped. You have to go all the way back to 2010 to find a comparable level of confidence today. And we've seen that confidence drop, particularly among smaller manufacturers, those with less than 50 employees, those with less than $1 million annually in revenue, whereas your larger manufacturers are noticeably more confident. And then the business climate, I think, is a real story, and we'll see this on the next slide with challenges. But today, 56% of manufacturers tell us that the business climate in Minnesota is worse now than it was 5 years ago, the highest level that we've seen in this study's history. And in terms of challenges, we've talked a lot about sort of diminishing concerns on workforce. Attracting qualified workers, retaining qualified workers has declined slightly this year as a priority. It's still a very important and persistent issue among manufacturers, for sure, but we've seen inflation and healthcare costs kind of emerge a little bit more than this year as a top-level concern, particularly among smaller manufacturers, again, which is the majority of our sample. And then that unfavorable business climate. In addition to it being the worst, we also see that particular issue rise as a challenge that could negatively impact future growth for manufacturers. It's up 7 points this year from where it was a year ago. I think one of the big takeaways here is clearly the legislature's actions, the governor's actions have had an impact and are having an impact on manufacturers here in Minnesota. We look specifically at kind of those three areas where we had somewhere between 65 to 68% of manufacturers who said it's had an effect on their business. I go back to that stat that 49% of manufacturers say at least one of those legislative actions has had a major effect on their business. And it's safe to say it's not been positive, because 2/3 of manufacturers tell us these legislative changes have made the state a much less attractive place to do business. And then finally, on strategic outlook, I would summarize it this way. When you look at succession planning, when you look at formal strategic plan, even mission, vision, values, a lot of the planning questions that we asked, we saw very stable, non-changing data. It is almost as if for a lot of manufacturers, strategic planning is kind of placed on hold for right now. And we see that in multiple places in this data set. So with that, we have the full presentation up on the website. And again, thank you to our sponsors, and thank you for your time and attention. Appreciate it.